Thank you, everyone, for joining us for what I know will be an energizing discussion. I'm Verunda Prince, Startup Atlanta board member and your moderator for today's webinar. Welcome to Startup Atlanta's webinar, Founder Foresight, Prepping Your Startup for 2023, the first in our new webinar series. Before we introduce our panelists, let's begin with a few informational items about Startup Atlanta. So if you look at Startup Atlanta, we're a nonprofit that's focused on really supporting the Metro Atlanta startup ecosystem. We couldn't do this without our many sponsors, and you see them listed here on the screen. Without them, this would not be possible. And again, the way that the Startup Atlanta network works and the network of resources that we have here are listed, everything from media and news to supporting female founders. Startup Atlanta is a place where we believe in supporting, growing, and helping startups become successful. I'm really looking forward to October, not only because it'll be a lot cooler in Atlanta, but because we're also going to have our Startup Awards, where we'll be honoring Favorite Son Ambassador Young and MailChimp's Ben Chestnut. And we're delighted to return to our in-person celebration. So I hope that you'll join us in October for what I know will be an amazing event. Now, a bit about today's featured guest. David Cummings is quickly becoming synonymous with successful Atlanta-based serial entrepreneurship. He's founded 10 companies, including Sales Loft, Terminus, and employed thousands of people and founded Atlanta Tech Village. David has firsthand experience with bootstrapping, exits, and investing. He's also the lead investor for Calendly. David is a Duke graduate, a native of Tallahassee, but has clearly made Atlanta home. One of my favorite notables about David is that ABC commonly refers to the Atlanta Business Chronicle, but we say it more colloquially as All About Cummings because he's so regularly and prominently featured in that publication. Welcome, David.
Thanks, Verunda. Great to be here. I'm excited for this discussion today.
Thank you. Shannon Sikoshia is Chief Events Investment Officer at SVB Private. In that role, Shannon is responsible for asset allocation, research, portfolio management, trading, and investment risk management. She works closely with business development and the wealth advisor teams to deliver customized wealth management solutions to clients. Prior to this role, Shannon was the Director of Manager Search and Selection for Silverbridge Advisors and worked at State Street Corporation. Shannon is also an alumna of Brandeis and member of several investment-related associations. Welcome, Shannon.
Thank you so much, Verunda. I'm so excited to be here.
I join you in that excitement. I'm excited because the experience and insights that both you, Shannon, and David bring to today's discussion will help us better understand and prepare for wherever we are and wherever we're going. You are both practitioners and thought leaders, creators of wealth, and ardent supporters of the communities in which you live. So let's get started. Shannon's going to help us level set by discussing just where the economy stands and might go in the future. Shannon?
Thank you so much, Brenda, and thank you all for joining us today. I'm going to take just a few minutes, about 15 minutes or so, to talk through where we are from an economic perspective, where we might be going, and I'll close out with some color on the private markets as we see it from my seat as an institutional allocator. So if we could go to the first slide, please. One of the things that has been very clear is that this has been the worst first half since 1970 for both U.S. stocks and U.S. bonds. So if you think about the microcosm of that, with specifically for certain assets such as long duration growth stocks, unprofitable tech companies, Bitcoin, more speculative assets, all of which had very strong performance in 2021. We've seen significant pressure on bonds as well as the Fed continues to raise interest rates. And for the most part, one of the things that's been challenging is that even for those who have a diversified public and private portfolio, it's been very difficult in the first half of 2022 to find a safe haven. Cash is not king when inflation is running at 9%. And so it's been very challenging for both public market investors, but as well as private market investors, founders, entrepreneurs, in getting some transparency in terms of what could be coming up next. And so this is really the past, and we're going to spend the rest of this conversation talking about what we expect to see for the rest of this year and into 2023. If we could go to the next slide, please. One of the biggest challenges that's facing the economy right now is this big question of recession. And for many people, there are different metrics that you need to look at from a recessionary perspective. For us, as we were coming into 2022, there were really three things that we were watching. They all related in some way, shape, or form to inflation. We actually termed our outlook for 2022 the inflation infiltration, because it really has infiltrated every corner of not only the US economy, but the global economy. But one of the things that we're grappling with is that between technology and changing business practices, including a focus on globalization, we have been in essentially a disinflationary environment for the last 3 decades. And so this re-emphasis on pricing, inputs, and efficiency, particularly from a capital allocation perspective, is a change from where we've been. The indicators that we have here, we are all essentially either neutral or negative. And you might be saying to me, well, Shannon, we just posted our second straight quarterly negative GDP print. Why isn't there more negative on this chart here? And the next couple of slides will show that, again, this disconnect between certain parts of the economy, the K-shaped recovery that really started in late 2020 and has been exacerbated by higher costs for food and gas. That is what's creating this question of whether we are truly in a recession or just a consumer demand-driven slowdown. And so we're going to talk about that over the course of the next couple of minutes. Next slide, please. The consumer is the driver of US GDP. And actually, the consumer globally is the driver of global GDP. So there remain a significant amount of questions around if the consumer can continue to support economic growth. You've probably heard a lot about consumer confidence. Consumer confidence has been really at the lowest that it's been in a decade. If you go back to the Great Financial Crisis, we really haven't seen the views on the expectations over the next 6 to 12 months for consumers be this low. And a big part of that has been gas prices. So if you look at the graph on the left, this is what I'm talking about when I talk about that K-shaped recovery. The percentage of spending in the consumer basket that's devoted to energy, significantly higher percentage in lower income households. And we're seeing that those lower income households are they have very little, if any, discretionary income at this point due to inflation. So where is that improvement? Could it be that we are, instead of destructing demand, could we just be delaying that demand? And if we go to the next slide, you'll see what I mean. On the right here, we all can see it in our day-to-day spending. Producer prices are significantly higher. Consumer prices are therefore significantly higher. Those two are very much tied to each other. In order to see any reasonable improvement in consumer inflation, we need to see improvement in producer inflation. But if you look at the left, a lot of this is energy. And so let's talk a little bit about that. We have 8 straight weeks of declining gasoline prices. That's a meaningful change. And it's not to say that it necessarily is going to shift all of these numbers overnight, but you're already starting to see that improvement in the last CPI print. So there has been, for us, this view that perhaps the consumer can start to come back online. There has been a destruction of savings. There certainly has been an uptick in credit card debt as a result of higher prices, but there really could be some improvement as we move into 2023 based on the fact that we do think that this decline in commodity prices, not just energy, but also lumber, copper, and other industrial metals, all of those prices have come down pretty markedly over the course of the last 8 to 12 weeks, depending on the commodity. And so that producer price inflation should start to come down as these inputs come down. And again, translating into that consumer price inflation. So this is the negative. This is really the biggest challenge in the economy. And it's the reason why many economists think that we are in a recessionary scenario. But if we go to the next slide, please. The top graph shows the US unemployment rate. The bottom graph shows the number of US job openings. And to be fair, if you were to ask me what the likelihood of 10.7 million jobs being filled, when we really only have about 3.5 million people looking for work, the likelihood is that these jobs are not going to be filled. Many of these jobs are aspirational jobs. Many of these jobs have been open for a significant amount of time already. And as we are seeing evidence, at least of some economic slowing in terms of demand, this number is going to start to come down. But if you think about what typically drives a recession, it typically is driven by a decline in consumer confidence that results in a decline in consumer spending, and that typically has been based on an uncertain or changed employment situation. And so, a lot of firms, particularly smaller firms, have been announcing layoffs, but the majority of the economy, particularly outside of the technology sector, is still continuing to hire. They're still looking for workers. And so we would have to start to see this job openings number come down pretty rapidly in order for those layoffs to increase markedly. So this is the bright spot. And it is the reason why, despite those 2 quarters of negative GDP, it's unlikely that the National Bureau of Economic Research is going to declare this as a recession. They put a significant amount of weight on the employment situation when they determine a recession. And so therefore, it is our view that we will not likely see them declare the first half of this year as a true recession by their definition, but rather just indications of a slowdown. So where do we sit today? If we go to the next slide. This is what businesses are saying. They are saying essentially that they're still concerned about supply chain disruptions. They're still concerned about higher energy prices that are emanating from the war in Ukraine. They're still concerned about higher food prices. We've seen China's COVID-19 policy really put a damper on the expected supply chain improvements that we were looking for coming into this year. And so businesses are also continuing to see, however, strong new orders. They're continuing to see strong deliveries. On the services side, demand has certainly picked up in the services part of the economy. And so a lot of these higher costs are being passed through to the end consumer. Companies are doing as much as they can to maintain their profitability. But these numbers, just to put it in context, anytime PMI numbers are above 50, that points to economic growth over the course of the next 6 to 12 months, tends to correlate under 50 economic slowdown over the course of the next 6 to 12 months. So these numbers, although they've come down a lot from their peak, are still pointing towards continued, if slower, growth into 2023. Next slide, please. And so the Fed's reacting to all of this. And for us, we look at that higher cost of capital for both businesses and for consumers. We're seeing it most pronounced right now on the consumer side in the housing market. You've seen a reset to what are historically, if you go back several decades, very reasonable mortgage rates. But that idea of affordability, when you couple that higher mortgage rate with an average median price of a single family home in the United States being at its highest level ever, that has created an affordability hurdle, particularly for first-time home buyers, that is going to be difficult until there is an anchoring to this new rate environment. It's also created a lot of the challenges in the equity market. The way that valuation is determined for most kind of fundamental equity investors is that future cash flows are discounted at a rate, and that determines price and the value of those cash flows. And when you're discounting at that higher rate, those future cash flows are worth less. And so for companies that have what we would call kind of a long duration horizon, this is the challenge. It's not just what you're paying today and that's come down. Has it come down enough based on expectations of where the Fed will be? And so just thinking about, it's not just businesses having to pay more to finance their projects. It's not just consumers having to pay more to borrow. It's really the entire valuation matrix from an equity perspective, the discounting of those cash flows. That's why you've seen such a huge reset in fast-growing companies that anticipate more of their cash flows are going to come in the future rather than today, and why you've seen real asset businesses, which frankly have underperformed over the last 10 years, come to the fore: manufacturing, energy, materials companies, because their cash flows tend to be in the shorter term, and their growth rates are lower. So those discounted valuations don't impact them as much. So there's so many different ways that the Fed is impacting the economy right now, both in the asset and the capital markets, but also in our day-to-day from a consumer and business perspective. So taking a step further with that, if we can go to the next slide. One of the things to think about is that equities tend to reflect persistent positive returns over time. And I think we're going to share these slides with you, but if you want to go back and sort of look at the year-to-date declines, it is an important fact that over a long enough time horizon, stocks generally do tend to perform positively, which leads us to, well, what should we be doing today? If we go to the next slide, please. I'm going to skip this. We'll talk about midterms later. We'll go to the next one. This is the challenge right here. When valuations are compressed and there is uncertainty about what valuations will be for companies going public, you see a decline in IPO activity. I just want to point out here, this is the first half of 2022 when compared with the first half of 2021. And IPOs, the number are down 73%, and the proceeds, the value is down almost 100%. So just think about that from the perspective of what we saw in 2021 to what we're seeing today. Again, it's not consistent across different regions. I found this to be really interesting in the APAC region. There continues to be, some strong IPO activity, both from a number of IPOs as well as a value of those IPOs. And so there is an inconsistency, but given that the US market saw so many IPOs last year at such high values, this is something that has hindered, I think, the interest and certainly has weighed on the outlook for startups over the course of the last year. Next slide, please. This draws to the point that the public market is probably not the end-all be-all for companies looking to monetize over the next 6 to 12 months. We saw a rise in the use of the SPAC vehicle in the post-pandemic era. That is essentially the SPAC activity has basically fallen off the cliff, and we do not expect there to be a return to SPAC activity. And so strategic M&A activity, as well as the use of secondaries, particularly in the PE space, we do think is going to be a source for potential liquidity for founders over this next 6 to 12 months. We do think that there will be a pickup again in IPO activity, but we don't think that's probably going to happen until the Fed has taken itself onto the sidelines, which is not likely to happen until the first quarter of next year. Next slide, please. Capital raising, it's actually pacing right about where we were in 2019, certainly down from where we saw in 2021. For those of you who are interested in where capital is being raised, the trends are actually fairly consistent with what we've seen over the last couple of years in terms of investors entering into the private capital market. But we are obviously going to be off of 2021 levels. Not surprising given the environment and that conversation about valuations that I discussed a couple of minutes ago. Next slide, please. I sort of want to close on this, and then we'll open it up, and I'll turn it back to Berunda for your questions. But from my seat as an institutional investor, from somebody that's working with founders, entrepreneurs, businesses, GPs of funds. The challenge is that if we go back in time, this environment is sort of the best time to be investing in private assets. And we just show this big blue arrow, post-dot-com bubble. You can also see some similar outsized performance from 2007, 2008, when we were sort of in an overheated valuation environment. And then you see those better returns coming in the 09 to 18 timeframe. So buying when others are fearful, doing what you can to reinvest not only in your business, but also to encourage investors to invest in the private markets. That's really where people like me sort of sit in that intersection, because we understand that this valuation reset doesn't necessarily equate to a reset in the expectations of these companies' growth. And so if we can, as investors, invest at a more reasonable valuation in companies that are still likely from a competitive perspective to deliver innovation and disruption across multiple sectors and industries, not just in the technology space, that is what we're trying to do. And so we talk a lot about the dry powder that's been raised. We talk a lot about the fundraising cycle over the course of the last couple of years. There continues to be significant amount of money raised this year. And the money that's put to work in this investment period over the next 2 to 3 years, that is, that's going to be money that has a higher level of scrutiny in terms of where those investments are going. And so I think that startups who can raise more money in this environment, it's likely because they have a great story, but they also have management that knows how to execute in an environment where money is not as cheap as it was over the last couple of years. And so with that, I'll turn it back to you, Berunda, and we'll see what questions we have from the audience.
Great. Thank you so much, Shannon. Thank you for helping us to understand not only where we are, but the factors that are going to influence where we're going to go. David, now that Shannon has helped us level set, talking about the K-shaped recovery, the disconnect, low consumer confidence, housing affordability, and what the funding market is likely to look like. Can you just share with us some thoughts about navigating this business environment that we're in right now?
Absolutely. From a business environment, it is really strange, almost unprecedented. We have such low unemployment, yet we have negative GDP growth. And then from an economy point of view, there's still plenty of supply chain challenges. I was talking to a friend last week who's in the real estate development business, and he was saying how a project that they had greenlighted and they had already gotten a bank loan for, the bank rescinded their loan because they felt like the inflation costs were going to make it so that the loan would be underwater. And so they wanted more equity on the deal. And so it basically went away. And so I think we're going to see more of that as inflation and supply chain continues to be a challenge. So from the startup world, the great thing about what we do and what we focus on is that we are as close as possible to the customer. Right. So one of the biggest advantages that startups have over big companies is the ability to both move fast and to stay extremely close to the customer. So whether the market's up or down, or whether the economy is booming or shrinking, staying close to the customer is one of the most important things that an entrepreneur can always do, but especially in the startup phase when the startup is so lean and so much opportunity to actually spend time one-on-one, over Zoom, in person, whatever the case might be. So my advice to entrepreneurs is twofold. Never lose sight of the fact that you got to stay as close to the customer as possible, right? In the startup world, on the development side, when building a product, there's a phrase, get out of the building. And the building used to be your office building, and now it's get out of your house. But this idea of getting out of the building is go see the customer wherever they are. Go to their house, go to their office, go to the Starbucks, get out of the building and go visit the customer. So most important thing, stay as close to the customer as possible. The second thing that I would emphasize for entrepreneurs is really around ensuring that the product or solution that you offer has tangible value. Tangible value. In the startup world, most entrepreneurs that I've seen fail, the product or solution that they offered was only incrementally better. It was only 5 or 10% better than the existing solutions on the market. The products that I've seen do extremely well were 10 times better, 1,000% better than the alternatives on the market. And as part of that being 10 times better, it was clear the value that the customer was receiving. So another way to put it, too many entrepreneurs have a product that's a nice to have. The ones that do extremely well have a must-have product. And one of the simple litmus tests on that is if you went to the customer tomorrow and said, hey, we're going out of business. I'm, glad we had a chance to work together. How loud does the customer scream that they can't stop using the product? And so too often entrepreneurs make a nice to have product that's a little bit better, but not dramatically better. The entrepreneurs that do the best have the products that are must-haves. And so those are two pieces of advice. Stay as close to the customer as possible and truly ensure that the product is a must-have and not a nice to have.
So let's dive into that a little deeper. And given your backgrounds and experiences as investors, how does that then shape what you just said, David, in terms of staying close to the customer as close as possible, making sure that you have tangible value in terms of your product and service? As an investor looking at companies to invest in, how does that shape your assessment of that?
Well, as an investor, when times are good, it's easy to focus on some of the more fun metrics like growth rate, absent profitability, or absent burn rate. As an investor, it's fun to focus on the growth in valuations and multiples of revenue. And so obviously when times have changed like they have now, it's important to coach the entrepreneur to go back to the first principles, back to the core concepts. And so again, when times are good, it was easier for the entrepreneur to sit in his or her house and work remotely and do some of the things that have become commonplace from COVID. And frankly, getting out of the house, frankly, going and getting on a plane and meeting that customer in person, frankly, driving the 5 hours to meet the customer at their office, going out into the field, doing some of the things that are harder, more effort, more grind. As an investor coaching entrepreneurs, it's back to basics and it's back to doing some of the things that we got away from doing for a variety of reasons, but for the long-term health of the business, we got to go back and do a lot of the basics and focus on those basics.
And Shannon, on the other side, what are you telling your clients in terms of how to invest now and how to go about assessing that?
Well, I love one of David's points, and so I'm going to elaborate a little bit in terms of the need to have. And so I think one of the things that we've really seen over the course of the last 10 years is that there has been an overemphasis on growth. We're even seeing from an investment perspective that the sales metrics are well ahead of anything that anybody's considering from an intrinsic value perspective. And so I think one of the things that we're looking at is we're taking the flip side of that. What are the challenges that our customers, our consumers are facing? Businesses are being forced to pay higher wages. They're not able to fill positions. They're seeing these higher input costs. And so we're looking to invest in businesses that are creating the opportunity to potentially drive costs down, or create greater productivity from current resources. And so there has been a true lack, really, especially in the industrial sector, the manufacturing sector, in productivity enhancements over the last 10 years because the cost of capital is really low. And frankly, we didn't have any wage growth for a decade. So companies were able to hire talent. They were able to hire consultants. Labor was cheap and available. And so now we're getting to the point where not only is it not available, but it's also not cheap. And so I think when a lot of those nice to have type products were really designed or sold to increase that growth rate incrementally for businesses. And now on the flip side, businesses are looking at how much can I save? How does this improve my margins? How does this solve problems for me in terms of my hiring challenges, my wage increases? That's where we're looking at. And we think there's a lot of different industries that you can find that are helping other businesses be better. I think one of your sponsors, if I was not mistaken, is Accenture that you showed on so that's a great example, right, of a company that's helping other companies be better. And I think when you're looking at a startup and you're thinking about a product that you want to put into operation, taking this different lens of how do I help another business, my consumer, my customer, do things better from an economic perspective is going to be a trend that persists in this now what will be higher price environment over the course of the next 5 to 10 years.
So David, you mentioned the infamous hockey stick that every startup presentation has. And Shannon, you talked about the fact that, growth is not growing in the same way. We're not seeing that in the same way. What are the opportunities for growth and thriving during downturns? Are there industry specific? Are there certain ones or certain kinds of businesses that seem to be more resilient than others? What are you seeing, and what have you learned from past experiences that may be appropriate and relatable for what we're currently experiencing?
So I would answer it slightly differently. So going back to the nice to have versus the must have, one way I like to think about it is how entrenched is the product or solution in the path of revenue? Mm-hmm. So this concept of in the path of revenue. So if you're doing a credit card processing, obviously you're on the front end of the revenue. If you're doing a sales and marketing tool, how definitive, how incontrovertible is the ROI from that solution that you're offering? So two different ways to think about it. One, are you in the path of revenue? And then two is how mission critical is the app or solution that you're offering? And so back to your question about verticals or areas of growth, with the low unemployment rate, one of the areas that we've seen, one of the startups we work closely with is in the HR software tech. Right? People are still having a hard time finding great people. There's still the great resignation. And so within the HR tech, there's a tremendous amount of growth. And so finding areas that are beneficiaries of this type of environment, right? Supply chain is talked about daily in the news. There's tons of great supply chain tech startups out there. And then of course, really just figuring out what the new post-COVID world looks like. So another startup that we're excited about is in the business of, software related to planning and executing corporate retreats and corporate offsites, right? And so they've exploded over the past 18 months and no signs of slowing down. So there are plenty of tailwinds in certain segments out there. And then my final point would be entrepreneurs generally have a grow at all costs mindset. And it's just grow, 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 grow. And I think when we hit times like this, it's important to offer an alternative, which is focus on the customers and potential customers that are most aligned with the types of customers you want to have, right? So a lot of entrepreneurs are just excited to get the next customer. And so I'd really encourage the entrepreneurs to think about where you want to be, what types of customers you want to serve, what types of characteristics they have, and then do the hard exercise of looking at your existing customers, which ones don't fit. So I've seen plenty of entrepreneurs do a variety of gymnastics to serve all their existing customers when it was clear that 10, 20% of their existing customers weren't good fits and were making unnatural requests of the startup to service them. And so there's plenty of opportunities to slow down to then speed up. But as an entrepreneur, to slow down to then speed up is typically antithetical to what the entrepreneur thinks and operates. So don't be afraid to fire customers, especially during turbulent times when you can say, oh, we just don't have the staff to service you well, even though they weren't necessarily aligned with your 5-year vision. So slow down to speed up, and don't be afraid to fire customers, especially during unusual times like today.
I would add to that one of the things that when we're looking at potential investments in startups is we understand that today might not be the best time to launch that secondary product or to pursue the land and expand that maybe you like to do over the course of the next couple of years. But we also don't want to see complacency and stagnation in idea generation, right? And so that the importance of that is kind of going out and making sure that you're seeing around the corner for your customer. That's a big part of why certain businesses thrive, is that they're anticipating the challenges that their customer is going to see even before their customer is letting them know about those challenges. That's where you can create that partnership in terms of partnering your idea generation with your end customer. The other thing that I would say is that in areas that we're really focused on telling our investors and the company and thinking about asking this to the companies that we invest in, where are you anchoring your expectations? Because if they're anchoring back to 2019, we're not going back to 2019. We're this post-pandemic world, whether we're testing for COVID in a year before a conference or not, we are in a different environment, whether it's hybrid work. I would point out healthcare too. If you think about the delivery of healthcare and frankly, the inability of us to effectively deliver healthcare strategically in this country to rural environments, to being able to it goes well beyond, sort of the teledoc. Oh yeah, I can see a doctor on my phone. That's really, we need to kind of get back to how do we shorten production and distribution, right? And that's for healthcare, that's for manufacturing. The sites of production need to be closer to the sites of distribution. That's what we're seeing here in terms of the effects of globalization and the lack of infrastructure spending, the lack of investment, particularly here in the United States. So I think there are some really interesting companies that are trying to help bridge that gap, trying to bridge the gap of the mobility of labor, making, focusing on bringing labor to where the jobs are. And so there's a number of different types of companies that I think are going to thrive in this post-pandemic era. But I think that as long as businesses are not trying to recreate a business strategy from prior to the pandemic and expect that to work, because a return to normalcy, the new normal is here already. But it is not going to go back to the way that we were in 2019.
Yeah. So Shannon, you just talked about the fact that we have a new normal, whatever that is going to be. And David, you talked about the war for talent. So how should we actually view this new economy? Can we see this as a entirely different paradigm shift, or is this part of the normal cadence of business cycles? what is it exactly? Can we even articulate what it is?
I think we're not quite there yet in terms of this being the new normal. I mean, just again, go back to that mismatch between the number of jobs that are available and the number of people that are actively seeking jobs. And we can talk, and I love to opine on, things like the decline in the participation rate and, the lack of support from a childcare perspective and all of the workers that we've lost in the economy over the course of the pandemic that were, had second or third jobs and helped supplement that discretionary income. But I think the way that we need to look at this is that we're probably not at that stable state just yet. There still is a lot of power in labor. Whether it's I don't want to take a job where I have to go into the office 5 days a week, and I don't want to take a job that is, for less than what I deem is appropriate, and the increases in wages that are being asked for new candidates are pretty significant. And so I feel like some of that will stabilize as these job openings come down. The perception is, okay, maybe I need to be a little bit more flexible. But I also think that there are real questions for companies in terms of, what does our real estate footprint look like? How, where should our hubs be? Should we be more focused on being in a market like Atlanta that has an incredible transportation hub that you can bring people into that can support, to David's point about things like events. It's increasingly important for companies to bring their employees together. And so do you think about allowing your business to grow in areas that can support this new sort of hybrid environment? And so I think we're not quite there on the labor side. I do think that labor, it's swung sort of all the way to this side, and we need that pendulum probably to swing back a little bit towards the middle. But I do think that companies are increasingly interested and should remain very focused on how do I keep my employees happy? And how do I listen to their concerns? Because that is this idea that people are going to stay with their company just because they're being employed and this is their sort of wage today. I do think that a little bit of the air has been let out of that balloon. And so I think, again, thinking about how are you paying people? How are you getting the next phase of employees that you need? How are you going to staff a project? How are you going to resource a project? Those are like real questions now in terms of growth for companies. Is I can't just assume that because I have a great idea, I can deliver it to my end customer, because I may not have the people, the resources, or the time to be able to do that in this constrained environment.
Yeah. And David, you talked about the war for talent. How is that changing how you advise your own companies that you invest in? And how is it changing maybe the way that you invest in those companies?
So, entrepreneurs are always asking that question. How do I recruit great people? How do I find software engineers, software developers? The saying that I like is one that's been around for a while. And it's the best time to start the recruiting process was 5 years ago. The next best time to start is immediately. From an entrepreneur's perspective, especially an entrepreneur that has product market fit, so the product's working, the customers love it, there's real momentum on the product. Once you have product market fit, and that's that search for a repeatable customer acquisition process, really the second phase, you got something that's working. Now let's figure out how to scale it. Frankly, 20 to 30% of the entrepreneur's time should be dedicated to recruiting. And recruiting is a broad term, right? Recruiting could be recruiting the next round of investors, could be recruiting team members, it could be recruiting executives, it could be recruiting mentors and advisors. But scaling a business is 90% people once you have a product working. And so my advice is for the entrepreneurs to really reorient their schedule once they have something that's working, once they have product market fit. And really, it should be 25% of your time on the recruiting front.
So let's discuss that a little bit, because you're both leaders of your respective organizations. What is your number one priority then in terms of this economic environment? What are you worried about, or what are you focused on?
Within our team, we're really focused on innovation. Obviously, it sounds trite, but we're really focused on helping entrepreneurs be the best they can be and achieve the greatest level of scale and impact that they can scale. So for us, there's still much more art than science. And it's really about both cultivating entrepreneurs through the studio and then obviously meeting with as many entrepreneurs as we can as direct investors. So for us, it's all about innovation and finding the next big thing.
When you find it, David, when we were meeting earlier, I already asked you this. I'm going to ask you now publicly. Just let me know what your portfolio investments are going to be, so that I can jump on that and share in that as well. But
yeah, we'll send up the bat signal and you'll know.
Great. And Shannon, what are you thinking about in terms of your priority for leading your organization?
Well, I think we're trying to in a fast growing organization, whether you're 10 people or whether you're 8,000 people, there is this push and pull in this type of environment that we just need to get people in the door to be able to fill the needs that we have. And, hiring managers are often, wearing multiple hats and player coaches, particularly if we're in a high growth environment. And so, really forcing us to be more thoughtful about making sure that we are hiring the right people. You don't want to get into this swing where you hire a bunch of people and then you realize that they're not the right cultural fit for your organization, or that you haven't fully vetted. Is this a point in time need from a role perspective? And do we need to have someone come in and do something that's more project based? But then, in a year, how is that person going to be able to impact the organization and help us grow? And so I think, in an environment such as this, you just have to be very thoughtful, and you have to make sure that you're partnering across your teams to say, what do we really need to prioritize right now? But what are we going to prioritize that could become this next phase of growth driver for us in a year or 2 years? And then the flip side of that is, making sure that the people that you have are engaged, right? When you have a lot, my company has a lot of open positions. If you go out to stv.com, there are a lot of positions out there. And so you want to make sure that your current employees, your current staff, your current team doesn't think that you're overly focused on the hiring process and, not like these new shiny objects that are coming in the door, and making sure that they understand that having an ongoing conversation and dialogue, making sure you're taking their feedback into account and allowing them growth opportunities. One of the things we've been really focused on is going back and doing we have frontline, obviously client facing people in financial services, doing a lot more in terms of vetting from them. What do you think we're doing? What do we need? What do we need to be focused on? What are you hearing from the clients? What are you hearing from our customers? And that's really helping us to better prioritize and resource in this environment.
So we're going to shift now into the Q&A portion of things. And I'm going to just give both Shannon and David advance warning that I'll come back and ask you for 3 takeaways for the attendance in today's webinar. But while you're thinking about that, here's some questions that are from the audience. Christian Ross asked the question of, what are techniques to experiment with pricing and receive true feedback? And then secondarily, with paid ads changing, where do you see your portfolio companies investing their marketing dollars and seeing a significant ROI?
David, you want to start with that one, and then I'll tag on.
Yeah, absolutely. On the paid advertising, right? There's this concept that Google and Facebook are the new rent, right? So in the olden days, you had to go rent a building and show your wares. And so nowadays you don't have to have the building, but you have to pay rent to Google and Facebook and others to capture attention. My favorite advice there is to continually invest in your own media, right? And so your own media is your own YouTube videos, your own podcast, your own blog posts. There is very much an importance to direct response advertising. Google AdWords, there's a reason Google has $100 billion of free cash flow, that it works and scale and everything else. But at the end of the day, I'm a big proponent of owning your own media. And so make your own podcast, make your own blog, make your own YouTube videos, get out there and make your own media. So that'd be my advice on the advertising front.
Yeah, there's no better way to market your company, your product, than yourself, right? Nobody tells that story better than you do. And so one of the things that we do is that, you know, our marketing department isn't sort of a standalone entity that's making those decisions. Even participating for me, right, in something like this is our community, right? This is SUB's community, and being an ambassador for the business. And so I think one of the things that we talk a lot about is how do we do just what David said, how do we create our own content, but how do we make sure that if we do have marketing dollars that we're spending, really understanding and looking at the analytics and the data to make sure that the money that we're spending is going to the type of clients and it's targeted enough that we can get a better hit rate or a better response. And so I do think we obviously measure eyeballs for everything that we do from a marketing perspective. But it's got to be the right eyeballs, right? Particularly if you're in a startup, right? Because you probably have a client base that you know exactly who your customer, to David's point, your ideal customer is. Just making sure that you can measure that, because marketing can be a big, deep hole of money that can be thrown in. And if you're not getting the ROI out of it, there's probably better ways that you can be supporting business growth than just pouring it into unprofitable marketing.
Yeah, I really love that, the idea of having targeted marketing. And then David, to your point, making sure that you're creating and owning your own content. That's one way to make sure that you have impact and influence at the same time. Here's another question from Kyle Painting saying, and this is for you, David, I think. I run an influencer marketing startup helping small businesses carry out effective influencer campaigns locally. David, what kinds of scaling challenges do you foresee for small business B2B products in the coming months?
On the scaling side, I assume he means scaling his own business. And so my question would go to how much of it is automated today, how much can be automated tomorrow, and then how much is, smart people doing things behind the scenes to make the influencer campaign successful. So really finding that balance between automating as much as possible and then the human component of it is really going to determine what the potential is for scale. So I don't know enough about it, but it sounds like there's people helping people. And while that does scale some, it's harder than if it's pure software or 99% software running the product for the customer.
Yeah. We have another question here asking, what best practices have you seen among companies who leverage productive affiliate programs where others are deputized to share their experience with the company and extend awareness into their communities?
On the affiliate side, purely from a B2B software perspective, I coach entrepreneurs that resellers and signing up partnerships is not a path to success. So if you have your own software product, you have product market fit, you're working on scaling the business, 99 times out of 100, when I've seen startups partner with bigger companies to do reseller programs or partnerships or consulting services around it and resell the product, it does not work. And the main reason it doesn't work is that the incentives are not aligned, right? So at Pardot, one of the companies that we started a number of years ago, one of our signed resellers was Dell. So you could go on Dell.com and buy the Pardot software. Now, while that sounds great, and Dell is a Fortune 500 company, at the end of the day, Dell didn't care because it didn't move the needle for their business. Dell also didn't care because, frankly, the sales reps on their side had more comp selling other products in the Dell portfolio than reselling Pardot as part of their cloud solutions. And so I've seen it play out many times where entrepreneurs get super excited that some big company is going to resell our product, and the vast majority of the time, it doesn't materialize into anything because incentives aren't aligned And frankly, the big companies, it's really hard to move the needle, and it's hard to get them to care about anything, let alone a small startup's product. So there are stories out there where it has worked, but my general advice to the entrepreneur is do everything you can to be successful on your own, going directly to the customer as opposed to indirectly through a channel.
Yeah, I would just add to David's point, when we're looking at companies, controlling your own narrative is really important. You have to be able to control the narrative around your company. You have to be able to control the customer response. And I think that having that arm's length relationship makes that really difficult, particularly if you're trying to disrupt sort of existing paradigms, existing applications in the software space. But it really extends across all industries. You want to be the one controlling your narrative, particularly when you're setting that tone from an initial relationship perspective.
Great, thank you. Thank you both. Before I officially kind of wrap things up, I do want to go back to the 3 takeaways that you want to leave with our participants today. And David, we'll start with you so that Shannon gets the last word on that.
Absolutely. So I'll reiterate the first 2 that I mentioned. And so those first 2 are the reason startups beat incumbents is the ability to move faster, be more agile, be more adaptive. And then that second takeaway, that second really critical piece is to have a must-have solution. Be in the path of revenue, be mission critical, don't be a nice to have. And my third takeaway, completely unrelated to the first 2, is that in the startup world, one of the beautiful things about it is that we aren't operating in a zero-sum game. It's not that if I win, you lose. The amazing thing about the startup world is that we are pushing the world forward. We're inventing the future. And so don't forget that. Don't forget that what we're doing is a net add to society. And so I think entrepreneurship and startups are one of the most noble things that we can do. And it's one of the reasons that as Americans, we have one of the most dynamic countries in the world.
Wow, great. And Shannon, your 3 takeaways?
Sure. So I think there's an incredible amount of negativity that's permeating the space. And there's 2 things to remember. Number one, from a public market perspective, small companies actually perform best coming out of a slowdown or a recession. And there is a significant opportunity, I think, to David's point, the underpinning of the U.S. economy is small businesses. Small businesses under 50 people actually is the underpinning of the U.S. economy. And so try not to get too mired in what's happening in the public markets when you're thinking about crafting your business strategy, because the public markets are incredibly cyclical and they will sort of bounce back at some point. Number 2, I think one of the things that has been overstated, I think, is also this, as I mentioned earlier, this re-emphasis on fixed asset businesses and the fact that, the heyday of technology as disruptor, innovator, productivity enhancer is over. I would say it's just beginning. We are, again, in a higher cost environment. Anything that you can do to create greater efficiency and productivity, much of which comes from technology, is going to thrive over the next 10 years. It's just going to take a little longer. And then on the third takeaway that I would say, one of the things that I'm hearing from a lot of the VCs that we work with that are investing in companies and startups right now, there is greater emphasis on the business. There's greater emphasis on the products. There's greater emphasis on the ability of management to execute. But you're also getting more engaged VCs, which can help you more in your business. And so if you are out there and you are looking for funding, know that it's going to be a harder road to get that funding approved, and the valuation might not be as attractive as it was last year, but you're also going to get probably better assistance, help, partnership from your VC than you would in another environment. And so I think that's a really important takeaway.
Yeah, well, thank you both. I love the fact that this level setting has ended with the inspiration of what David is saying in terms of small businesses, and Shannon echoing that as well, being the drivers of our economy here. And despite the challenges, small businesses have always found ways to succeed and thrive and grow. And I'm convinced that we'll do this in this economy as well. So thank you both, Shannon and David, for your time, your insights, your experiences today. Thank to all of the panelists and participants for joining us today as well. And I hope you got some takeaways and some insights to help you as you continue to build your businesses in this economy and in the future. And the last thing that I want to leave everybody with is just a reminder again of our October session for Startup Atlanta Awards. Again, the Lifetime Achievement Awards nominees are going to be Ben Chestnut from MailChimp, and then Ambassador Andrew Young, native son here from Atlanta. So look forward to seeing all of you there. Thank you again. It was my honor and my delight to spend this hour with the two of you and with all of you virtually as well. And I look forward to seeing you at the event. And thank you for allowing Startup Atlanta to support what we all believe in is really important, which is a thriving, growing Atlanta ecosystem. Have a good day, everybody.